family every time it gets released. And this time the economy or whatever, but it doesn't matter. So the point is the feds were giving out free money. And so what happens is this. So it was to start. So all the startups. So Silicon Valley Bank is a big bank, one of the biggest banks over here. It's actually I think it's like one of the biggest banks in the world, dude. So
top 20.
Yep. And so Silicon Valley Bank serves Silicon Valley. You know what Silicon Valley is? Startups for technology, tech startups. So a lot of tech startups go there because that's the famous. They do funding for that. And so what happens is you have all these deposits coming in. So back then, 0% interest rate. So people were just giving the banks money. That's why the VC venture capitalists were starting all these startups. And where do they come to the money from? They have hella money, dude. Free money. So they're just giving out, loaning out people. So what happens is, so now they have all that money in the bank. And so the guy at the bank, the chief investment officer of the bank, like, whoa, we have freaking excess of billions of dollars. You know what the normal bank does? They give out loans. Your traditional bank gives out loans. They take your money, they hold it, and they give out loans. So it's basically the only time that they will go under is all the loans default, right, guys? Yeah. And that's what happened during the Fannie Mae days and all that. We'll talk about that too. And that's going to talk about how you day trade, right? But so the traditional model of a bank is they give out loans. That's how they're not going to fucking take all your money and start putting it into Bitcoin. And that's exactly why Bitcoin blew up. Okay, so we'll get into that too. So the traditional banking model is very conservative because the bank is supposed to be conservative. They're holding your money. It's not their money. Yeah, it's your money. When you want the money back, you should get the money back.
And there are regulators that are supposed to be backing this and honestly monitoring everything that's going on.
The problem is this. The problem is the fact that everything works until it doesn't, right? Yeah. It never fails until it fails. And so what happened was you have all this excess money, and they decided to buy bonds with it. They stopped giving out loans. Why would you give out a loan when you make more money in bonds? They're buying like 1.5% where the hell the bonds were at, right? And so the problem is this. They're making money, cool, because the interest rates were zero. And they did not anticipate that the Feds would raise the interest rates so quickly and so much and so sharply. So when the interest rate goes up, the bond values go down. So now they're sitting for, I'll make it up, like 1.5% interest on the yield on the bond.
Yeah, something like that.
And then now it's 5%. They're underwater, dude. So what they needed to do is they got rid of their bonds. I think that I read it, they lost $2 billion. Okay, because when the interest rates go up, what happens? These companies start to need money, and so they start to take money out. And so they saw an influx of people because these companies were laying people off. They didn't have money for payroll and all that, and they started coming to the banks to take more money out. And so now the banks are like, holy crap, it's okay. One company coming to take out $50 million. It's cool. We have billions. But now you multiply in by 200 people coming in at the bank at the same time. So that's why they call it a run for the banks. A run for the bank means that it's a domino effect where everybody gets scared. They start running to the bank to take the money out. And so if a normal society comes, I have a lot of money in the bank, hopefully, right? You guys have some money in the bank. We're not all going to take all our money out at the same time. Yeah. And that is what they're banking on. The fact that they're keeping your money. But it's like life insurance. Not everybody's going to die at the same time, but if everybody dies at the same time, they're going to go bankrupt. How can they pay everybody back, right? Yeah, exactly. Same thing with health insurance. I knock on wood, we don't have a serious health issue. But imagine if COVID happened, wipe everybody out. Yeah, that's what happened, right? And so if everybody runs to the doctor and has a disease at the same time, they're all going to go bankrupt. Yeah. But the fact that they're playing the 100-year-long game, that's how insurance works. They're betting that only 2% of the population needs this cancer treatment. And everybody else just doesn't even go to get their teeth cleaned, right? And that's how the insurance works. And so the Rutherford Bank, what happened was that the interest rate went way up so much, inflation, all this, these startup companies started losing money. And the bank did not have cash reserves. They wasted their money instead of giving out traditional loans or playing it safe. They bought these stupid ass bonds and now they're underwater. They're day trading your money. Yeah. The fuck?
Yeah, that's crazy.
Imagine if you're the bank and I found out you lost all my money because you traded bonds. Yeah. The hell? What the hell you know about trading? Yeah. Shouldn't you be putting into a T-bill that's safe
Yeah.
was too boring. Why would you put a boring T-bill when the bonds are making